Imagine a storm last night off the coast of Madagascar in 1695. Thunder cracks like cannon fire. Rain slashes sideways. And somewhere in that chaos, a battered ship, its sails shredded, its hull groaning, limps toward a hidden cove. On board, a crew of desperate men, not soldiers or sailors in the traditional sense, but pirates, clutch a single hope that their ship survives long enough to reach shore, and that if it doesn't, they won't be left with nothing. This wasn't just about survival. It was about risk and how to manage it. Because long before Wall Street, before Lloyd's of London, before actuaries in gray suits crunched numbers in skyscrapers, it was these outlaws of sea who devised one of the most foundational ideas in modern finance: mutual protection against loss. The truth is, pirates didn't just plunder gold and terrorize trade routes. They quietly laid the groundwork for what we now call insurance. It sounds absurd at first. How could lawless marauders, infamous for violence and chaos, invent something so orderly, so structured, so civilized? But that's the irony of history. Sometimes the most sophisticated systems emerge not from palaces or parliaments, but from the margins, from people forced to create order where none existed. And pirates, contrary to the swashbuckling caricatures of Hollywood, were among the most organized, pragmatic, and surprisingly democratic groups of their era. They operated under written constitutions called Articles of Agreement, which every crew member signed before a voyage. These weren't just rules. They were contracts. And within them lay the seeds of modern risk-sharing. For instance, if a pirate lost a limb in battle, he was compensated from a common fund. A lost right arm, 600 pieces of 8. A left leg, 500. A finger, 100. This wasn't charity. It was insurance. A pooled resource, funded by a share of every plunder, set aside explicitly to protect individuals from catastrophic personal loss. And it worked because it had to. On a pirate ship, survival depended on trust. If a man knew he'd be abandoned if injured, he'd fight half-heartedly, or worse, mutiny. But if he knew his brothers would care for him, he'd stand his ground, even in the face of cannon fire. This mutual guarantee created cohesion, loyalty, and operational efficiency. In essence, pirates invented a form of disability insurance, funded by premiums their share of loot, with defined payouts based on severity of injury. But it went deeper. Their entire economic model was built on shared risk. Unlike naval or merchant ships, where captains held absolute power and kept most of the profit, pirate crews operated as collectives. The captain and quartermaster were elected, and loot was divided almost equally. Often 1.5 or 2 shares for officers, 1 for the rest. This egalitarian structure wasn't born of idealism, but necessity. Piracy was a high-risk venture. Ships sank. Crews were captured. Men died. No single investor, because pirates rarely had external backers, could afford total loss. So they spread the risk among themselves. Every man had skin in the game, and every man bore a piece of the potential ruin. This is the core principle of insurance, risk pooling. And pirates practice it with ruthless clarity. Now, let's rewind a bit. Where did this idea come from? Surprisingly, not from the pirates themselves, at least not originally. The concept of sharing maritime risk dates back centuries. Ancient Phoenician and Greek merchants would take out loans where repayment was forgiven if the ship sank, a practice called finis nauticum or bottomry. In medieval Europe, ship owners and merchants formed syndicates to share cargo losses. By the 1600s, London's coffee houses, especially Edward Lloyd's, became informal exchanges where ship owners, merchants, and underwriters gathered to spread risk. But here's the crucial difference. Those systems were hierarchical, slow, and often corrupt. They served the wealthy. Pirates, with no access to formal capital or legal recourse, had to build their own version, faster, fairer, and enforced by sheer necessity. Their insurance wasn't written on parchment in a vault. It was etched into the culture of the crew. And because piracy thrived in the late 1600s and early 1700s, a golden age fueled by European colonial wars, weak naval enforcement, and booming transatlantic trade, their model spread rapidly. Ships like those of Bartholomew Roberts or Edward Blackbeard didn't just attack vessels. They absorbed their crews. And with those crews came ideas, practices, and systems. The pirate code of one ship would blend with another, evolving into a de facto maritime common law. Among these shared practices was a compensation system. Historians like Peter Leeson, in his book The Invisible Hook, argue that pirate governance was not only rational but economically sophisticated. They created institutions that solved collective action problems, like free riding or desertion, through incentive structures eerily similar to modern corporate governance. And insurance was central to that. Consider this. A merchant sailor in the 1700s had almost no safety net. If he lost a hand unloading cargo, he was discarded. If his ship sank, he drowned or was enslaved. But a pirate? He had a contract. He had a fund. He had brothers who'd seen the same horrors and understood the stakes. This wasn't just appealing. It was revolutionary. It's no wonder that many sailors willingly joined pirate crews, not out of greed alone, but because piracy offered something the legitimate world denied: security. Now, you might wonder, if pirates invented this, why do we credit them? Why is Lloyd's of London hailed as the birthplace of marine insurance, not a pirate cove in Bahamas? The answer lies in legitimacy. Pirates operated outside the law. Their systems, however brilliant, were invisible to official history. When insurance formalized in the 18th century, it was built by merchants and bankers who cited Roman law or medieval guilds, not buccaneers. But the DNA is there. The idea that risk should be shared, that loss should be compensated from a collective pool, that premium should be proportional to exposure. All of this mirrors pirate practice. Even the language echoes. Underwriting, for example, comes from wealthy men literally writing their names under the terms of a risk agreement in Lloyd's coffee house. But pirates did the same, just with blood oaths instead of ink. And while Lloyd's dealt in ships and cargo, pirates ensured something far more personal: the human body. In that sense, they were pioneers of personal injury insurance, long before factories or railroads made it mainstream. Fast forward today, and the legacy is all around us. Health insurance, life insurance, disability coverage, they all rest on the same principle. We pay into a pool so that when disaster strikes one of us, the many absorb the blow. It's a social contract disguised as a financial product. And though we've layered it with algorithms, regulations, and corporate branding, the core remains unchanged. Pirates understood that uncertainty is the one constant in life, and especially at sea. You can't control the weather. You can't stop a cannonball. But you can decide how you respond to loss. You can choose isolation, or you can choose solidarity. Pirates, for all their brutality, chose the latter. They built micro-societies where mutual aid wasn't optional. It was survival. And in doing so, they created a blueprint for managing risk that the civilized world would later adopt, sanitize, and profit from, without ever mentioning its outlaw origins. So the next time you sign an insurance policy, remember, somewhere in its fine print, buried under clauses and disclaimers, echoes the voice of a pirate captain swearing on a cutlass that no man left behind. Because in the end, insurance isn't about money, it's about trust. And in the lawless void of the open ocean, trust was the rarest, most valuable currency of all.